Maybe this time really is different. Maybe AI changes the economy, maybe valuations stay high for years, maybe markets keep climbing. But investors have said that in every major bubble in history. And eventually, reality catches up. So this video is not about predicting a crash, it's simply asking one question. If valuations reverted, how low could markets go? Because history suggests the answer may be far lower than most investors realise. One of the strangest things about market bubbles is that they feel safest near the top. Rising prices create confidence, confidence attracts more investors, and that pushes prices even higher. And history shows this happening again and again. The Dow in the 1920s, Japan in the 80s, the Nasdaq in the dot-com bubble, and arguably stock markets today. These melt-ups can last far longer than people expect and become far bigger than people imagine. But eventually, every melt-up reaches a limit. And when sentiment finally changes, the declines can be brutal. This is the history of S&P 500 drawdowns over the last century. The Great Depression saw markets fall almost 90%. The 1973 oil crisis cut markets roughly in half. The dot-com crash destroyed huge amounts of wealth, especially in technology stocks. The global financial crisis saw the S&P 500 fall more than 50%. Even the COVID crash wiped out over 30% in just weeks. Now, importantly, these crashes all had different causes. War, recession, banking crises, speculation, rising interest rates, overvaluation. But they all shared one thing in common. At the peak, most investors believed the market would keep going higher. So the question is not, could markets fall? Of course they could. History tells us that clearly. The real question is, how far? Because when markets become highly valued, even small changes in sentiment can create very large declines. So rather than making predictions, let's look at valuations. What happens if the markets simply return to historical averages? What happens if valuations reverted to previous bear market lows? And what would that actually mean for investors today? So let's start with one of the most widely followed valuation measures, the cyclically adjusted price-to-earnings ratio, or CAPE. This looks at market prices relative to inflation-adjusted earnings over the last 10 years. Historically, the average CAPE ratio for the US market has been around 17. Today, it is above 41. That puts current valuations close to some of the most expensive levels in modern financial history, only really exceeded during the peak of the dot-com bubble. So what happens if valuations reverted? If the CAPE ratio simply returned to its long-term historical average? The implied decline for the S&P 500 would be roughly 58%. And if valuations fell back toward levels seen during major historical bear markets, the decline could be closer to 68%. Now again, that's not a prediction, it's simply a mathematical exercise based on historical valuation ranges, but it just shows how much downside can exist when starting valuations are extremely high. Another commonly used valuation measure is the forward price-to-earnings ratio. Instead of looking at the last 10 years of earnings like CAPE, this looks at expected earnings over the next 12 months. And historically, the US market has traded much lower than today. The current forward PE ratio is around 21, compared to roughly 19 over the last decade, around 15 over the last 20 years, and close to 10 during the depths of the global financial crisis. So by historical standards, markets are still expensive. So what happens if forward valuations normalized? If markets returned to their 10-year average valuation, the implied decline would be around 12%. If they reverted to the 20-year average, the decline becomes closer to 28%. And if valuations compress toward levels seen during major bear markets, the downside could exceed 50%. Another way to value the market is price to book. This compares the value of companies in the market to the value of their net assets. The current price to book ratio is close to 5.9. The long-term average is closer to 3, and during the global financial crisis it fell below 2. So what happens if price-to-book ratios reverted lower? If valuations simply returned to historical averages, the implied decline would be around 46%. And if valuations compressed toward global financial crisis levels, the decline could approach 70%. Another valuation measure is price to sales. This compares company valuations to revenues rather than profits. And this matters because profits can fluctuate heavily during recessions, but sales are often more stable. Today, the market price-to-sales ratio is around 3.7. The historical average is closer to 1.8, and during the global financial crisis, it fell below 1. If price-to-sales ratios simply returned to historical averages, the implied decline would be just over 50%. And if valuations reverted toward crisis-level lows, the downside could become extremely severe. Again, this does not mean markets will collapse by 78%, but it demonstrates how much optimism is currently embedded into valuations. When investors are willing to pay historically extreme prices for sales, earnings, and assets, the margin for error becomes very small. So across multiple valuation measures, the conclusion is broadly the same. If markets simply reverted toward long-term average valuations, the implied downside could be somewhere in the region of 30 to 60%. Now that might sound extreme, but historically that is not unusual. That is what major bear markets do, especially when starting valuations are elevated. But during periods of real panic, markets do not usually stop at fair value. They often overshoot to the downside. During major historical crises, valuations compressed far below average levels. And in those scenarios, the implied downside today could become significantly larger. So what actually causes markets to fall back toward average valuations? Usually, it's not one single thing. It is some kind of shock that breaks investor confidence. Sometimes it's a recession, sometimes inflation, sometimes rising interest rates, sometimes a banking crisis, sometimes war or geopolitical instability, and sometimes it is simply that investors realize they've become too optimistic. Because when valuations are very high, markets become fragile. There is less margin for error, less room for disappointment. And when sentiment changes, the repricing can happen very quickly, especially after long periods where investors begin to believe markets only go up. Now, to be balanced, there is also a bullish case. The economy may continue growing. Artificial intelligence may genuinely boost productivity. Corporate profits may rise far faster than expected. And unlike previous eras, today's largest companies are incredibly profitable, global, and dominant. It is also possible that structurally higher valuations are justified in a world where capital is increasingly concentrated in technology, index investing continues growing, and investors have few attractive alternatives to equities. And importantly, markets do not need to crash. Valuations can normalize slowly over many years through earnings growth, inflation, and long periods of sideways returns. So this video is not saying the market is definitely about to collapse. It is simply saying when valuations are historically high, investors should at least understand the range of possible outcomes. So what would I actually do if markets fell heavily from here? Honestly, probably very little at first, because nobody knows where the bottom is. Markets can always fall further than seems rational. But if valuations became materially cheaper, I would gradually become more aggressive. And if we eventually reach levels associated with real fear and capitulation, that's probably where the best long-term opportunities would exist. Because historically, the greatest returns usually come from buying when sentiment is terrible, news is frightening, and most investors want to sell. Which is one reason I currently hold a large defensive allocation. Lots of cash, short-duration inflation-linked bonds, and absolute return strategies. Not because I'm certain a crash is coming, but because I want to buy when things are cheap and not expensive. And I'm happy to wait until then.